Now, what we're seeing right now in the U.S. economy is nothing short of, what's a good word? All I can think of is remarkable and astonishing, but remarkable seems too little and astonishing seems too much, so surprising, I guess, but it's very much a Goldilocks environment right now. What's up, apes? Welcome back to another edition of the 𝗙𝗟𝗡𝗚's daily podcast of the day. Thank you all for joining us here once again on this beautiful Monday, October 7th, 2024. It is currently 7:36 p.m. and we got a lot to talk about, so let's go ahead and get right into it. The 𝗪𝗚𝗚 portfolio. This is our proprietary in-house trading portfolio at Wall Street Oasis. Down about 93 basis points for the session. Now, I was ready to go ahead and fire the entire team at 𝗪𝗚𝗚 earlier, but then I went ahead and turned my brain on, looked at the rest of markets to see what was going on out there. Even with the 93 basis point loss, we still did better than the S&P 500. S&P 500 finished the day 96 basis points lower. If we look at the heat map for the index, it looks like Nvidia and Eli Lilly were basically the only companies to rise, and energy stocks too, because the odds of war occurring are increasing, so obviously energy stocks are increasing right alongside it. Nothing ExxonMobil loves more than some bombs in the Middle East. Jeez, that was kind of crude, but either way, crude oil, no pun intended, off the dome. Anyway, the NASDAQ was down 90 basis points for the session, so beat us a little bit. And that makes sense. Nvidia was, like I said, one of the top performers. It has a higher weighting in the NASDAQ and a lower weighting in the 𝗪𝗚𝗚 portfolio, so it makes sense that it kind of helped out the indices more so than it did for us here today. It was actually a pretty good day for small cap stocks and pretty good. Everything is respective in markets. It was down 78 basis points for the session. Looks like it had a pretty healthy climb from about 3 p.m. until close. So I guess we're getting bullish on small caps. And then finally, we also saw the Dow lose 94 basis points for the session. But of course, since it's the Dow, I doubt anybody on earth cares. It's 30 stocks. Who could care less about what's going on there? But let's go ahead and move right along into some of these banana bits for the session here today. The stories that we wanted to bring to your attention but didn't care enough about to write about here today. So, crude oil, like we just said with energy stocks, the reason that energy stocks are rising is because war tensions going in the Middle East are causing oil prices to rise. And that means a higher margin for these energy companies, at least in the short to intermediate term. So everybody's just kind of sitting on their thumbs waiting for Israel and Iran to start bombing each other again. So, we'll see how this plays out. It's a goddamn tragedy, as any war is. So hopefully it can be resolved relatively quickly. But with the way that this has been going, it certainly doesn't seem like it will be. But we'll keep our fingers crossed and we hope everybody's okay over there. There was an epic ruling in U.S. courts here today. That is the pun of the century right there, because Epic Games just won their lawsuit against Google with a judge basically saying that Google and the Android platform has to make it easier for competitive app stores to come onto the system. So it can't just be the Google Play app anymore. They're all going to be competitive app stores, and specifically Epic Games is going to be launching one of its own. So I cannot wait to see how that plays out and how this ruling impacts Apple going forward as well. Speaking of tragedies going on in the world, that's always a good segue. If you needed another reason not to live in Florida, this hurricane is absolutely it. I don't know if you guys have heard much about my boy Hurricane Milton. He's actually not my boy. We're beefing heavily right now because he's going to go rip through Central Florida, Orlando, Tampa, Gainesville. Hope all of our apes down there are doing well, and any family members of our apes are doing well down there too. But in addition to oppressively hot summers, hurricane season falls, and then all the Florida man headlines out there. I don't know why you would want to live there, but nonetheless, we hope everybody's doing okay because you're about to get slammed by a Category 5 hurricane. Super microcomputers, meanwhile, is slamming the market with Category 5 levels of gaslighting, if you ask me. They solidified their position as an industry leader in gaslighting because they came out here yesterday and they published some release saying like, oh my god, demand for some product is so high. I didn't even read it because fuck you. File your goddamn 10K before you come out with any bullshit news like that. You're trying to distract everybody from what's actually going on under the hood that Hindenburg research uncovered. So whatever, we'll publish flashy press releases and just delay our 10K filing as long as humanly possible. I cannot wait to see that thing because I know it's going to be absolute garbage. Otherwise, you would have probably filed it already. Anyway, activist investor Starboard Value, they just took a $1 billion stake in Pfizer. You might remember Pfizer from saving the world in 2020 and 2021. Well, Turns out they can't sell anything besides COVID-19 shots, and Starboard Value thinks that they should be able to sell some shit that isn't just COVID-19, so they put $1 billion in there to go in and try to use some of their activist magic to turn things around at Pfizer. Finally, Generac. This is a generator company, as the name implies. Shares were particularly charged up here on Monday because of these hurricanes coming in. We had, still recovering from Helene in Florida, Georgia, North Carolina, Eastern Tennessee. Hope everybody's doing okay in those regions as well. But with hurricane season kind of starting to hit a peak, it makes sense for markets to get a little bit more optimistic on generator companies, because typically, and this might be a bold statement, but I think homeowners tend to appreciate having electricity. That is exactly what Generac is going to give you. Let's go ahead and move into our big story of the day, Macro Monkey. We were talking about rate cut cocaine. Now, don't get too excited over there because it's not what you think. Now, I know I should probably state this clearly from the beginning. I'm not a doctor. I know that was probably confusing for many of you, but I'm actually not a medical doctor. I'm a moron, to be honest with you. But I do know that when doctors sign the 𝗏𝗏𝗏𝗏 oath, or whatever it's called, one of the most important things that they're kind of agreeing or committing to is to first do no harm. This is a doctrine of the medical system, is that, whatever interventions, medications we give, we want to make sure they're not going to cause additional harm on the patient. So as an example, and the example that we're going to run with for the entire piece here today, no doctor would prescribe an otherwise healthy person cocaine for drowsiness, or unless your doctor's really cool, or in the 1920s. Like I said, I'm no doctor. I don't know if that's what they would actually do, but Dr. Federal Reserve seems to disagree with the 𝗏𝗏𝗏𝗏𝗏 oath in that case, because Fed Chair Nurse 𝗟𝗏𝗏 and Dr. Federal Reserve are about to give a few doses of cocaine, rate cut cocaine specifically, over the next couple of quarters and years. Now, what we're seeing right now in the U.S. economy is nothing short of, what's a good word? All I can think of is remarkable and astonishing, but remarkable seems too little and astonishing seems too much. So surprising, I guess, but it's very much a Goldilocks environment right now. So we're at 3% real GDP growth. We're cruising along pretty healthily. And so overall, the U.S. economy is looking good. So especially in light of Friday's jobs report, it was pretty clear on Monday that bond markets, the quote-unquote smart money as it's typically referred to, is starting to think a little bit differently about the path forward for interest rates. And this very well could be why equity markets were lower on the day more broadly. So if we go ahead and take a look at the daily yield curve. Now, what the yield curve is, it's basically a way to plot the treasury yield curve on a given point in time. And when I say yield curve, I mean what you do is you take the different maturity dates of all of the treasuries, bills, notes, and bonds that they're going to be issuing. You take the maturities and put them on the x-axis, and you take the yields and you put it on the y-axis, and you plot those, and it's supposed to look nice like that. But instead, what we look like in the United States is a little something like this. It's actually more like, kind of like Big Dipper style, I guess, but just without the top of the dipper cover. Whatever. It's a very weird shape. We've talked about the inverted yield curve a bunch here, wise apes. You guys know what I mean. Google the yield curve if you have any more questions. We've been seeing some interesting activity in the yield curve lately. So for most of the year, and especially most of the summer, we've seen a declining yield curve, especially in the long, intermediate, and longer dated end of the spectrum. Now, short-term yields, that's kind of getting into like quantum markets. Like things kind of start to break down a little bit at the 1, 2, and 3 month level. So we're only going to be talking about 6 months and beyond. And the one that we want to focus on here is going to be the 2-year yield. So before we get into the 2-year yield, just know that every day so far in October and every day since that jobs report came out last Friday, yield curves have been climbing across the maturity spectrum. And again, we're talking about 6 months and beyond. It's been climbing on a daily basis, with the biggest jump being from Thursday to Friday, again, in light of that jobs report. So what does that mean? Well, that tells us that the bond market thinks that yields aren't necessarily going to be going as low as anticipated. Now, the 2-year note, going back to our boy, the 2-year note, this is kind of like the market's proxy for its path forward of interest rates. You kind of plot out what you expect going forward, and if you expect interest rates to be declining going forward, participants in the bond market are going to start buying existing bonds that are in the markets. They're going to start buying notes and bonds that have been issued already that have that higher coupon coming from issuance, because after these rate cuts, the coupon at issuance is going to be lower. So everybody's going to want that higher coupon. With all of that demand chasing, whatever's floating around in the secondary market already, that is going to push prices up and pull yields lower. So that's what we would expect if we were, if the bond market was anticipating a bunch of rate cuts, and it's exactly what we saw over the summer. That trend has been reversed over the past couple of days, and the question we're facing right now is whether this is a longer-term trend of, either rising yield curves or slowing the decline in the yield curve. if it's kind of a longer term trend or if this is just, like a hiccup in light of a strong jobs report. So that's the question that we're kind of facing right now, because at the time of writing, the 2-year yield was sitting at about 4%. That's 50 basis points higher than it was less than 2 weeks ago. And in the bond market, that is a run-up like NVIDIA shares from 2022 until right now. Bond markets, especially treasuries with the liquidity in that market, usually doesn't move by this much. But we're seeing the exact same data in the interest rate futures market as well. Now, if we look at the CME group, they do a great job of simplifying the interest rate futures market into just basic probabilities of what they expect for the path of rates going forward. So a week ago, there was a 0% chance that at the November 7th meeting that the Fed would hold interest rates steady at their current rate of 475 to 500 basis points. There was also a 35% chance of another 50 basis point cut, getting us down to 425 to 450. Now, the current state of play is that there is a 0% chance of a 50 basis point cut and a 15% chance of a no cut, of holding the same. So less than a week, things have changed quite a bit on both sides of the spectrum, from interest rate futures as well as the bond market. So this is the smart money kind of telling us what they expect going forward. Now, these movements and those probabilities might seem minuscule, but it is the exact opposite. If we keep in mind, it's not just the level that is going to be important. It's not the level of these probabilities or these yields that matters, but it is the direction that they're heading in from a predictive perspective that actually matters. And they are all moving higher. So it's telling us something pretty damn clear. And I mean, it's understandable why. We've seen 2 months in a row of declining unemployment after 5 months in a row of rising unemployment. We've seen very strong job creation. It's been increasing over the past 4 months consecutively. So the employment market is looking absolutely fine. Hiring increased last month as well. We're also seeing nominal spending from consumers up 5.2% annually and up 2.9% on a real basis. We're seeing declining default rates from both consumer and corporate borrowers. We're seeing slowly increasing mortgage applications. Personal savings rate is still a very healthy 4.8% and on the rise. ISM services data came in very strong, although ISM manufacturing data is relatively weak. An already high wage growth has increased to 3.1% in the past couple of months. Now, all of that stuff, absolutely fantastic for the U.S. economy. This is the kind of Goldilocks period that we're in. So this stuff is all looking great. Like from a Federal Reserve central bank perspective, it's kind of one of those if it ain't broke, don't fix it kind of thing. So that's why you see the bond market, interest rate markets are starting to kind of price for less rate cuts going forward, especially in November. Now, we're going to get a lot of data between now and then. We're going to get the Q3 GDP growth report. We'll get the first estimate for Q3 GDP growth. Again, the Atlanta Fed is expecting about 2.5% right now. Very healthy, but a decline from what we saw in Q2. We'll get a CPI report, a PCE report, and the October jobs report before this meeting actually occurs. So it'll be interesting to see exactly how the Federal Reserve and how markets react in the interim, but still, it's changing the most important narrative that's going on in markets right now. The most important narrative being that rate cuts are on the way lower, or rates are on the way lower, and we're going to be starting we're kind of entering the next cutting cycle, but that is all getting thrown for a loop right now. All right, let's go ahead and move into some of these big stock movers of the day. Anybody ever heard of Duckhorn portfolio? I'd be amazed if you had, because I sure as hell didn't. But if you're a connoisseur of wine, maybe you did. But even if you didn't, you're invited. There's going to be a party at 9595 Wilshire Boulevard in Beverly Hills, California tonight, because the headquarters of that company just bought almost $2 billion worth of wine. Now, the Duckhorn portfolio, this is a luxury winemaker. It's apparently North America's premier luxury wine company. It's a luxury winemaker that just got bought out by a company called Butterfly Equities. So Butterfly Equities, this is a California-based private equity company. I just told you its exact address, so of course it's California-based. They just went ahead and they bought Duckhorn portfolio, which is, again, a wine company for $1.95 billion. Now, this acquisition is being done at an $11.10 share price. This is a 63.5% premium to Duckhorn's 90-day VWAP. That's the volume-weighted average price over the past 90 days. Typically, it's going to be 90 days, and sometimes they do 6 months for these transactions. But more importantly, it was a 105% premium to Friday's close. Yes, more than double the price that the company closed at on Friday. So it's no surprise that shares in the Duckhorn portfolio were up 102.97% on the day. This might be an all-time record for the Daily Peel. I don't think we've ever written about a stock that increased by this much. Most of the time, it's just because it's some shitty biotech company that's getting pumped and dumped, or some acquisition of some random software or something like that. But This was actually pretty cool because it's a $1 billion acquisition and it caused, a huge uptick in the price action right there. So pretty cool stuff coming out of the Duckhorn portfolio. Ticker symbol is NAPA as well, which is pretty fucking sick if you ask me. So good stuff coming from those companies. Now, although we are in the stock talking about section of the podcast video here today, this next one, you'd be hard-pressed to find any reason to call this a company. The Trump Media and Technology Group. I don't know how shares rose 11.45% on the day here. There was nothing but bad news, or at least what would traditionally be considered bad news. But again, Trump Media is kind of in the quantum realm of fucking equity markets, I guess, as well, because there's literally no liquidity behind this thing whatsoever. So don't short it, don't buy it, because you're going to get fucked over at some point. Just avoid this at all costs. So what happened? Trump Media and Technology Group, the sprawling media empire that is the fucking 6 users on Truth Social, and I guess they were going to start like a streaming network and like their own version of Instagram too. I really have no idea what's going on, and the company doesn't either, because the chief operating officer just resigned. Andrew Northwall stepped down from the chief operating officer position after realizing there was nothing to operate. That's not what the reports actually said, but that, if you can read between the lines, that's essentially what it means. And I am still just trying to figure out why the hell that took shares higher on the day. But, nonetheless, stock is up 11.5%. Moving on down into what's rotten, our stinky rotten moves of the day, we have insurance companies first and foremost. This insurance ETF, KIE, it's the iShares Insurance ETF, was down 3.44% on the day, but there was quite a lot of variability going on in insurance stocks. We saw Florida-based Universal Insurance Group was down 19.5% on the session here today because of exactly what we were talking about beforehand. So it's kind of peak of hurricane season. Most of these insurance companies have some kind of like extreme weather provision where they're going to have to actually do their job and pay money to the customers that buy into them. And when these companies found out that they're going to have to actually serve their purpose, shares fell off an absolute cliff. So Hurricane Milton is kind of the big driving force behind this, but even reinsurers like Everest Group and others sold off as well. Everest Group is down 8.5%. Reinsurers, by the way, are insurance companies for insurance companies. So very damn bad over in that market right now. I mean, they're expecting tens of billions of dollars worth of damages. So, it's not too surprising to see these stocks down, but being down so much was certainly a bit of a surprise. But what's even more surprising is the fact that the shares in a company that makes chocolate could possibly decline. I don't know who would ever sell their shares in Hershey's, but a lot of them were getting sold here today. The stock was down 2.25% because I guess we don't like sweet treats anymore. We don't like joy, happiness, obesity. I don't know what's happening to the America that I loved. But Hershey is just out here getting bullied. UBS and Bernstein, these are investment banks, sell-side investment banks that went ahead and downgraded their rating. Might as well spit all over Hershey's face, if you ask me. They downgraded to neutral and market weight, respectively. UBS did so based on this idea that cocoa inflation is no longer going to be able to be passed on to consumers because of the inflation rate in the United States has somewhat normalized and been ticking lower. Now, Bernstein's perspective was that the popularity of GLP-1s is going to make shipping the volume that Hershey is used to much harder. So they're expecting lower volume and then, lower margins from the UBS side of things. So all around, the real life Willy Wonka, it's definitely not a great time to be them, but still shares were only down 2.25%, so probably not a huge concern. Final story of the day, we're talking about these lazy bastard dock workers finally going back to work. So the good news here is that our bananas are no longer actively rotting off in some container in the East Coast. Sad and alone. They're finally here getting warmed up in my belly once again. I actually did have a banana today, so shout out to the Boston dock workers because I'm sure it came from you guys. But the bad news is that these striking dock workers and their employers have really not reached a deal whatsoever, and we're going to be back exactly where we are right now in 99 days. Really 100 days from right now, but 99 days from when you're going to be watching this. As a recap, in case anybody lives under a fucking rock, last Monday, 45,000 longshoremen represented by the International Longshoremen Association, the largest union of dock workers in North America, went on strike. They walked off the job because they hate you and they hate the U.S. economy. Well, really, it's because the ILA and the organization that represents their employers, the United States Maritime Association, which is USMX instead of USMA for some reason, don't really know exactly why, but nonetheless, they came to a tentative agreement. Now, what they have been debating, there's two big pieces of contention within these negotiations. First, is the ILA wants 77% wage increases, whereas the USMX is only willing to give them a measly little 50% wage increase. Yeah, tiny. Who can survive off of a 50% raise? And at the same time, the ILA is also demanding an outright ban on automation at its ports. Completely ridiculous request to be asking, but nonetheless, they have a huge economic impact. Like we talked about recently, about 72% of the imported food that comes into the United States come through these ports that, the ILA is actively striking on over in the East Coast, or no longer actively, but they were doing that. So overall, this is just to say that the ILA has a lot of economic power when they feel like they want to put that to use. But what that means is that when they go on strike, they're effectively holding the U.S. economy hostage because of the importance of those agricultural imports, and more importantly, just its contributions to GDP growth in its entirety. And at the same time, it's really going to fuck over the export market, especially in regions like Puerto Rico that, are heavily dependent on shipments that come out of East Coast ports in the United States. So when these guys go on strike, the rest of us are fucked. While they're sitting at home fucking kicking their feet up, waiting for the 77% wage increase. Either way, they didn't get a 77% wage increase. The tentative deal that they came at is settled at a 62% wage increase. Still pretty pathetic if you ask me, but I guess it's fine for them for now. The real sticking point of the negotiations is the automation side of thing. And, it makes sense because every other port in every other country in the world is automated. Now, when I say that, there's highly varying degrees of automation. If you look at the port of Rotterdam in Rotterdam in the Netherlands, that is considered to be the most advanced or the most automated port in the entire world. If you look across Europe, and especially China as well, these ports are more automated than human-driven. Now, in the United States, you couldn't find that if you looked under every single rock in the entire country. Now, there's very little automation in comparison at U.S. ports. So this is kind of a big sticking point, but it's, it's like trying to fight the night turning into the day by keeping the lights off in your bedroom. It's just not going to happen at all, and you're going to get steamrolled by the rest of the world. So this is putting the U.S. and these companies at a significant competitive disadvantage because the ILA is demanding that this. They actually said let me see what the quote they said, because they didn't say outright automation or outright ban on automation. They said absolute airtight anti-automation stance. That's exactly what they said. And specifically, they don't want any automation of cranes, gates, or trucks. Basically, they don't want things to run efficiently whatsoever. So if you ask me, it looks like the ILA is already winning these negotiations. So the Biden administration didn't end up using the Taft-Hartley Act of 1947 in order to invoke a suspension for the strike for 90 days. That is what the Taft-Hartley Act is designed to do, so that, the government can come in and say, no, keep working while we kind of take over the negotiations. We act as like an arbitrator for the negotiations. It's a good way to handle this. It's not pro-union, it's not pro-employer, it's just is. That's just the typical process that there's going to be. By not invoking Taft-Hartley and instead, quote, strong-arming, both sides into this deal, as a lot of media reports are saying that the Biden administration did, they've essentially forced the employers of the ILA to concede on a key negotiating point. So now the ILA can go and say, we didn't get our 77% wage increase, so you better give us the automation ban. And what are these employers going to say? They're going to be like, you got a 62% wage increase and you still want to fuck me over on the cost side of things even more, like with automation. So it puts them in a very tricky position from a negotiating perspective. So, January 15th, is the day that this kind of tentative deal expires. So we're going to be right back to striking by January 15th, and then the new president is going to get sworn in 5 days later and have a big problem on his hands. So it's going to be interesting to see exactly how this plays out, but that's the current situation. Our bananas are okay, but only for now. We got to figure out what the hell is going on over here. That about does it for us today. Let's go ahead and finish up with a quote of the day. We have from Mr. John Kenneth Galbraith. He once said, "The function of economic forecasting is to make astrology look respectable." I absolutely love it, especially on days like today when we're kind of trying to, encompass the entire picture of the U.S. economy and how wrong we and everybody else are in all of our projections. So that about does it for us here today, apes. Thank you guys all for joining us here once again on the world's most popular and influential podcast. Give Joe Rogan some notes on how he can, maybe get to our level someday, but it's going to take a lot of work for him. That about does it for us. We will see you guys tomorrow. Until then, happy trading, happy investing, and bye now.